Welcome to Mint Funds Update. My name is Marek Przyczkowski and I'm joined by Ryan Falls. Today we will talk about our market outlook and what happened with our funds last month. Looking at our expectations, we still think that the most likely scenario for the next 12 months is soft landing. That is a scenario where global growth remains robust and inflation comes back to the target of central banks. In that scenario, we would expect to see some rate cuts by the end of this year. Now, what supports our view is really just taking a step back and looking what happened. We all obviously know that COVID was quite unusual time, and we had enormous expenditure. Here in this chart, you can see the US Fed expenditure, and following that was inflation. Now we believe that we entered the phase of great normalization, where a lot of things are just going back to where they were before the pandemic. Now, one of the key things for our outlook is inflation. We've discussed inflation over the last few months, but what's really important is the composition of the headline inflation. As you can see, goods inflation is well within the target of central banks. However, services inflation is something that is still problematic. Now, whilst we talk about service inflation, it's again something which we covered more recently, and it is a shelter inflation. Here on the left-hand side, you can see that shelter, and even recently, this chart is from end of January, but even recent months, the composition is pretty much the same. Shelter dominates the services. And what is shelter? In the US, this is driven mostly by what's called owner's equivalent rent. That is a survey when homeowners are asked how much do they think their house could be rented for. So it's not really the rents that people pay. It's what people think they could get for their house. Now, on the right-hand side, we are showing a chart which shows you that whilst the owner's equivalent rent does not follow real rents, the blue line, it lags, but it does follow it with roughly 12-month lag. So what we would expect is that shelter inflation comes back to the normal range within the next 6 months. Now, the other thing which has been debated is really around, can inflation reaccelerate? We think that it is unlikely. The biggest risk would be overheating in the job market. But here we are showing you the US job openings. As you can see, that has been trending low, and we believe that it should come back to the normal range. On the other hand, we see wages growth as moderating over the last few months. So we don't think there is a risk of this being a source of inflation moving forward. Now, in terms of market implications, we see a positive outlook for equities. Now, we believe that we should see a strong expansion of earnings over the next 2 years. Well, currently, analyst expectations are looking quite positive. Now, last year we saw margin contraction, but this year we believe that margins should improve due to cost reductions. Now, why would margins improve? There's quite a few things here. Very briefly, just looking on the left-hand side, as you can see, interest payments have reduced. Then in the middle, we see that whilst the wage pressures were the case last year, they are now subsiding. And finally, on the right-hand side, AI, that has been very topical. We have quite a lot of exposure to that theme in our portfolios. But what we see is that there is enormous expansion of investment in AI. And we believe that this can be a significant factor of increasing productivity and reducing costs moving forward. Now, as far as bonds are concerned, it's been a tricky market for bonds that are volatile. Here on the left-hand side, you can see how markets were pricing quite a lot of cuts at the beginning of the year. Then in March, Most of these cuts were priced out, and currently it's all very data driven. So depending on what is the data, what's the inflation release, and what is the job openings release, that tends to move. But we believe that as inflation improves, outlook improves, and disinflation continues, we should see bond yields falling from the levels that we see at the moment. And now passing on to Ryan to talk about funds.
Thanks, Mark. Yeah, as Mark said, I'll quickly take you through both of the diversified funds performance for this month, and we'll start off with the income fund. So overall, income fund was up 0.8% this month. So asset class performance was positive for the May. This is in the backdrop of equities continuing to edge higher and global interest rates retreating from the highs we see in April. So looking at each individual asset class, fixed income was the largest positive contribution at plus 0.7%. Global equities returned plus 0.1%, and Australasian equities were flat for the month. Turning now to the positive contributors within each sleeve, global equities, we had Schneider Electric up 5.7% and Charter Communications up 12.2%. And they're the top two contributors. Schneider Electric continued its strong run from April, announcing a few joint ventures during the month that market participants reacted quite positively to. Charter Communications was buoyed on news of a distribution tie-up with Paramount Global. Domestically, within Australasian equities, we had Telix Pharmaceuticals up 20.6% for the month, and had a very strong last few days of May as they announced positive results from their prostate therapy medical trial. And then turning to fixed income specifically, it performed positively as interest rates drifted down despite some hawkish sentiment from the May RBNZ meeting. Looking at the negative contributors, we had domestically within Australasian, we had Skellerup Holdings was down 21.6%. It continued to slide from April amid continuing concerns in the weakening New Zealand domestic economic environment. Within global equities, we had Accenture was down 6.2%, and that was the main detractor for performance in May. It also had some negative price momentum from the previous 2 months continuing to weigh on. Markets shrugged off a few announcements of strategic partnerships over the month as the share price lagged the broader market. Turning now to the growth fund, so it was also positive in May, so it was up plus 2.1%. And as well as that, global equities was up plus 1.9%, and that was the top contributor as markets rebounded from April. Fixed income was up plus 0.1%, and that was the next positive contributor, with Australasian equities slightly below flat at negative 0.1%, and that was a really small detraction. Turning now to the positive contributors for the growth fund, in global equities, Netflix Incorporated was up 16.5%, and Analog Devices was up 16.9%, and they are our top two contributors in May. With Analog Devices, markets reacted quite positively to their Q2 earnings announcement, with both revenues and earnings well above market consensus. As mentioned previously, fixed income performed positively as rates drifted down. And then domestically as well, we had Telix Pharmaceuticals, and again, they had a strong end of the month with their prostate therapy medical trial positive results. Negative contributors within the growth fund, within global equities, we had Accenture again, negative 6.2%, and LVMH was down 5.1%, and that were the two main detractors for performance in May. As I mentioned, for Accenture, that was negative price momentum from the previous 2 months, continuing to weigh on it. But for LVMH, the wider luxury goods sector struggled with news of slowing consumers' strength globally. Domestically, in Australasian equities, we had Skellerup Holdings again down 21.6%, and then also Somerset Holdings was down 14.4%, with Somerset having numerous analysts downgrading their target prices over May for the firm. And that's all from me.
Okay, thank you for listening. If you have any questions, please send them to info@mintasset.co.nz.